Hello, so today we're going to be starting our next unit, which is on banking transactions and saving money. And today's lesson will just be about the banking transactions. So we're going to start off by just learning some key terms that are associated with banking. The first here is withdrawal. So that's another way to say taking money out of your account. And so for you, you'll see that all of the definitions are just at the bottom, so you'll just need to drag and drop them to the correct spot there. That way you don't have to write everything out. Our next key term here is deposit, and this is another way to say putting money into your account. Next, we have direct deposit. So this is when you're putting your paycheck into your account automatically. So rather than getting a paper paycheck, going into the bank and having to deposit it, or going to a machine and having to deposit it, you set it up with your work to automatically go right into your account. You could do the same with things coming out of your account, which we have here in the next key term, which is automatic withdrawal. So this is when you give permission to have a company automatically take whatever you owe out of your account. So this would be used for paying bills. So let's imagine you have a phone bill, and rather than have to go on and manually pay it each month, you just tell the company it's okay, you give them your bank information, and they can just take it out monthly, whatever it is that you owe. So in order to do this, you need to sign some paperwork and give them your banking information. The next one here is electronic funds transfer, or EFT. So this is the movement of money between different accounts. This could be across different banks or within the same bank, as long as it's under the same person's name. So for example, when you're paying your own phone bill, so you're moving money from your bank account to your phone bill account, and they're both under your name, this would be an example of an EFT. So there's lots of different examples. It covers kind of a broad range of transactions. E-transfer, on the other end of it here, is where you actually are transferring money to someone with a different name. So it's not your own account, you're transferring money to someone else. So for example, if you owe your friend some money, you can just send them an e-transfer rather than have to give them cash or write them a check. And it doesn't matter, again, if they're at the same bank as you or if they are at a different bank, the e-transfers will still work. The next one here is service charge. So this is the fees that the bank charges you for different features that are on your account. Transaction is any activity, so money moving in or out, that happens to your bank account. Interest. So this is the amount of money that's kind of made, or money that kind of adds up that's owed. And it's based on a percentage of whatever total is in a certain account. So this could be used when saving money. So you put a chunk of money into an account, and then they calculate a percentage of that and keep adding it to the account. So then your savings account keeps growing and growing by a little bit. So that's called interest, and it's used for savings, so when money is growing, but it also could be used when you're owing money. So if you've borrowed money and you're going to take a few years to pay that money back, they might calculate interest, let's say monthly, and you'll have to owe a little bit more and more each month. So at the end of the 2 years, let's say, you won't have just paid back exactly what you borrowed, you're paying back even more. So they've charged you that extra, which is called interest. And we calculate it by using percent. Bank statement. So that's a summary of all transactions to an account over a certain period of time, which is generally a month. Next, we have self-service banking. And this, let me just move it down here, is banking that you do on your own using various means. So you can use internet banking, ATMs, and so on. So as long as you're doing it by yourself and no one at the bank has helped you to do it, then that's called self-service. Anything at the bank where someone else is helping you do is called full service. So if you're sitting down with a financial advisor or completing transactions with a teller, that would be an example of full service banking. And the last two here are ATM. So this just stands for automated teller machine, which is just another way to say a bank machine. And then we have ABM. which is an automated banking machine. So again, just another name for an. Okay, moving on to the next page here. So we've got two different types of accounts, and these are the main ones at least. So we've got checking account and savings account. So the characteristics of a checking account. So generally a checking account is where you store and spend your daily money. So this is a place where your paychecks would be deposited and the place from you're getting the money to make all your regular purchases, things like bill payments and just withdrawals and things like that. If we hop over to savings account, on the other hand, so this is a place you'd want to store your money for a longer period of time. So this isn't money that you're spending on a regular basis. You wouldn't want to put that into a savings account. You want to put money that you're not going to touch for a long time into a savings account. Savings accounts can also earn interest on the money that's being stored. So that's the thing we were talking about before, where your money will kind of grow based on a percent, whatever percent interest that account has. So some pros of each. So some pros of a checking account is with checking, you're often allowed to have numerous transactions without being charged for them. So that's good when you're using it on a daily basis, you know, when you're grocery shopping or paying bills or transferring money. You don't want to have to get charged for every little thing you do on your account. Savings account, a pro is that you make interest. So you're making money without having to do any work. You just put the money in the bank and eventually you get a little bit more and more money the longer it sits in that bank. Some cons of each of them. The con for checking account would be that it doesn't pay interest. So it's not a very good place if you're storing money for a long period of time that you don't plan to touch, because often checking accounts have no interest or very, very little interest. So your money either isn't growing at all or it won't grow by very much. And then the con for savings account would be that it's not meant for your daily transactions. So generally in a savings account, you don't have any transactions that you can have for free. So anything that you're doing, they're charging you extra on. So if you want to withdraw money or pay a bill or transfer someone, you're maybe getting like a $2 charge for every single time you do that. So again, you don't want to make this your regular daily account. Next, we're going to do a little bit of an investigation that involves interest, which we've talked about above. So let's imagine you have $5,000, which you plan to put in a bank account for a year. So we want to calculate the interest if you held the money in a checking account or savings. So let's imagine our checking account has 0.5% interest annually, and our savings has 2.5% interest annually. So we're going to calculate the difference of how much interest is earned on each of these different types of accounts. So the first thing that we're going to want to do is change our percent into a decimal. So we do that by dividing, I've got a highlighter here. Sorry, so we do that by dividing by 100. Divide by 100, or by moving the decimal place 2 places to the left. So when we do that, our 0.5% becomes 0.005. So we've got a very, very small decimal number there. And now we're going to calculate the interest by multiplying this percent as a decimal to our original amount that we're putting into the bank, which is 5,000. So we're going to take our 5,000 and then we're going to multiply that by our decimal. And when we do that, we get 25. So over the whole year, if we kept that money just sitting there, the amount of interest we would make is just $25. Now, if we hop on over to our savings account, we can see our percent there is a bit bigger. So if we change this to a percent, we're going to get 0.025. And then we're going to multiply this by 5,000 to calculate our interest. So we've got 5,000 times 0.025. And when we do that, we get 125. So as we can see in our savings account, we did make more interest. So we were able to make more money from just our money sitting there than we did in a checking account. On to the next page here. So there's different ways that you can get access to your account. So here's the kind of the top 3 that we would be using. So a teller, so going into a bank and actually dealing with the person who works behind the counter at the bank. So here are some things that you can do with that person. So you can cash checks, deposit money, withdraw money, transfer money. You can make wire transfers. You can get foreign currency. You can pay bills. You can get money orders or bank drafts, and you can view balances. Those are, again, just some examples. The list goes on. There are many more things you can do, but these are the common things that you can do. At an ATM, so that's, again, a bank machine, some things that you can do are cash checks, deposit money, withdraw money, transfer money, pay bills, and view your balances. And finally, over here on online banking, which is becoming more and more popular each year. So things you can do would be deposit checks. So you can now actually not even have to take your check into a bank. You can just take a picture of the front and back and upload it online. And then that money will get deposited to your account. You can transfer money, you can pay bills, you can get direct deposit or direct withdrawal forms. That way you can give to your employer or give to different companies to take bills out automatically. You can set up appointments to meet with a financial advisor. So you can make these appointments online rather than having to go in or call. You can open up a bank account online from your home. You can send or accept e-transfers, and you can view balances. So these are the most common things that we would do for banking. So we're going to move on down here to task number 1. So Mrs. Wong has an account at CIBC, which charges her 60 cents per transaction, unless she pays a monthly fee of $5.95, and then that would allow her to make unlimited transactions. So assuming she makes at least this many transactions, so looking at that bank statement below, let's try to determine if she should pay the monthly fee. So we're going to see which option's cheaper, paying the $5.95 or just getting charged 60 cents per transaction, which one in this case is the cheapest one. So just a quick review of what a transaction is. This to the right there, you'll see, so these are the things that CIBC counts as a transaction. So debit purchases, so anytime you go to a store and use your debit card, withdrawals from a bank machine, Interac e-transfers, so that would be either, it doesn't say just deposits or withdrawals, so we're going to assume it's both. Transfers of any kind, checks, pre-authorized payments, that's like bill payments that are coming out, and bill payments. So we're going to look through this bank statement and see how many transactions that I used. So we'll see the first one was a payroll deposit. So deposit, a payroll was not considered a transaction at CIBC. So we're not going to count that one, but we do have a bill payment for a MasterCard, an Interact withdrawal, an electronics purchase, another bill payment, another ATM withdrawal, another Interact purchase at the grocery store, another bill payment. Let's see, the next one's direct deposit. So again, that's our paycheck, so we don't count that as a transaction. A transfer though, so it said that transfers were also considered a transaction. Pre-authorized payments, checks, and finally a mortgage payment, so another bill payment. So now if we count these all up, let's see how many transactions I did. 1, 2, 3. 11. So I did 11 transactions. So now to see how much I would be charged for that, it says that it would charge me up here 60 cents per transaction. So I'm going to take my 60 cents and multiply it by how many transactions I did to figure out my total. And when I do that, I get that I have $6.60. So that's how much I would have been charged for using my bank account that many times in a month. So we can see that that's a bit more than had I just paid the $5.95 monthly fee and just got unlimited transactions. So in this case, I'm going to write therefore she should pay the monthly fee. Okay. And now the last page on this note is actually your next video. So I'm going to wrap this up and send you off to watch the next video.